Anyway. Good evening. How nice of you to come. Thank you. Well, the midterm break is coming up, of course, and the first week after the midterm break, I can't believe someone sent me an email about this yesterday. Beginning of every lecture I say this. They obviously don't listen to the lectures or watch them or anything. After the midterm break, the first week back, you'll be doing your midterm test in here, which is multiple choice questions exactly, well not exactly, but kind of like the past midterm test on the website where there are answers and explanations of the answers too. You also, of course, that week have to hand in your group assignment, which has been up on the web for some time, so you've all been able to see, which you can do in groups of between 1 and 4 people. The person who's responsible for the assignment this semester and every semester since about 1867 on financial economics is Senada Nukic, so I'm now going to hand over to Senada, who's going to explain to you how to use Solver to assist you with preparing that assignment. Thank you.
Hi guys. You can hear me? Yep. Okay, cool. So, you have the assignment that it's from my memory, which I have apparently set up. I must have been drunk that night. It was basically that you needed to construct an efficient frontier. In particular, there's two types of the efficient frontiers that you need to construct, and I'll show you today each one of them how to do it. But before I start, I presume you have printed out your PowerPoint slides, the handouts for this lecture, and I'll use the basically slides, and I'll use obviously the Excel spreadsheet to show you how exactly it's being done in Excel spreadsheet. So I'll have to switch from one to the other on occasions. So the first thing, I believe Stephen has already told you what efficient frontier is. It basically represents a set of the portfolios for which you have maximized the rate of return for any given level of the risk, or in other words, you can say it as for any given level of the rate of return, you minimizing the rate of the risk associated with investment in that particular portfolio. So there is a number of the steps that are involved to find what the efficient frontier exactly is. First one, we will need to find what the expected return for each of the assets that you include in your portfolio is. Then we will calculate the standard deviation on the returns of each of the assets and the correlation of those returns, or in other words, the correlation matrix. Then we will find what the covariance matrix is. And then we're going to use that covariance matrix to construct something that we call border multiply covariance matrix. It's a bit of a funny word, but all that it does is basically is surrounded by the weights the assets and how much, hence the proportion of the assets that you are including in your final portfolio. You're going to need that border multiply covariance matrix in order to find what the portfolio variance is. And once you find the portfolio variance, all you need to do is find the square root of that variance to find out what the standard deviation of your whole portfolio is. And we will also find the portfolio expected return. So once you have information about the risk of the portfolio and rate of return associated with each of the portfolio, we can use it to construct what we call the efficient frontier. And if you have a look, there's on the following slide, there's information given to you about 3 types of assets that we're going to include in our final portfolio. We label them simply as a US asset, UK asset, and Australian asset. So for each one of those, we have calculated standard deviation and expected return. I'll show you quickly, because I do not have the data that we use to find the standard deviation expected returns for these original 3 assets. So I just made up some returns, holding period yields on this so-called small value stock. And to find the expected return, all you have to do is enter sign equal, enter average, open the brackets and select all of the data, close the brackets, and that will give you 11.16%. That's what you expect the return on this, for this particular sample set is. The next thing you will need to do is find what the standard deviation is for this asset returns. So all you have to do is type in sign equal and type in STDEV. Open the brackets and select the data, and then close the brackets and just enter, and it will give you what the standard deviation is. Some of you might actually go into the tools and a data analysis. In a data analysis window, there is a tool that you can use to find the standard deviation. Is it there? It's not this one here. It's a function key. So if you go to the tool menu, if I can see it now, that would be great. But just be careful, I can't see it now, but just in case some of you try to use the different techniques, there's a number of the different measures for the standard deviation in Excel that you could potentially use, but not every single one of them is actually appropriate for the purposes that we are trying to do here, because if you have done statistics previously, you probably have come across something that we call population standard deviation and a sample standard deviation. If you're using a population standard deviation, then in denominator there is only n for the number of observations included, while in a sample standard deviation in denominator you're going to get n minus 1. So for our purposes here, because we don't know the whole population, we only know the sample, the appropriate standard deviation formula should be the one that has in denominator n minus 1, which if you're using Excel spreadsheet formula, that is basically STDEV, the what I use here. So just be mindful of that, because I have seen a number of the people in the past make that mistake straight away at the beginning of the assignment calculations. So once you have expected return and standard deviation, such as I have here, for my 3 assets that I'm going to include in my portfolio, I can go ahead and then find what the correlation matrix between the returns on those 3 assets is. To find the correlation matrix, you will normally go to the tools, go to the data analysis, and then you will just find here as one of the tools correlation given to you. You will click on OK, and you will select all of the data that is given to you in your assignment for all of those different types of assets. You will make sure that you don't select the label. If you do select the label, then just click on the box next to it, and then you can also choose where you want your output to be displayed. So if you want to be displayed on the same worksheet, click next to the output range, click in the box inside so you see the arrow flashing there, and then just click anywhere within the spreadsheet where you actually want the data to be, the output to be displayed. Once again, I don't have the final data, so I can't show you that part, but I'm hoping that you're not going to have difficulties with that. In case that you do have a difficulty, I suggest that you use help menu and just type in correlation, and then you find exactly how to complete how to find the correlation matrix. I have already found correlation matrix for the data that is given to me in my example, but one interesting thing that you might notice is that under the correlation matrix, only the half of this matrix or half of this box is going to be filled with the numbers. For us, what we need to do, we need to fill it, the whole box, the whole table with the numbers. In particular, you might notice here the cell that should show us correlation between the returns on the asset, UK asset and US asset, is missing the value. But if I go across, I'll find here under the first column, that's exactly where the correlation on the returns between these two assets is. So all I have to do is copy that cell and paste the value in the one where it's missing. So similarly here, there's two cells that are missing values. And that is, the first cell is its missing value, it's the correlation on the returns on the assets of Australian asset and US asset. Under the first column, it's there. It's basically the last value given to us. You can see it shows us the US and Australian returns correlation. So all I have to do is copy and paste that across. And similarly, for the correlation between the returns on the Australian asset and UK asset, I'll find that if you have a look, this is Australian asset, this is UK asset, so that's where the correlation coefficient is. So I just have to paste it across. So now you can see what I meant by whole of the box being filled with the numbers, because when you use the correlation metrics and calculations by using data analysis tool, you will not get the whole box filled, you will only get the half of it. And I think I should have mentioned it right at the beginning, that when you go under the tools, if you do not find the data analysis there, you should go and click under the add-ins here, and under the add-ins, you should click next to the Analysis Tool Pack and Analysis Tool Pack VBA. That's what it should give you, the data analysis tool. Just in case if you go home and you try to do it on a computer yourself and you don't see it. But in your handouts, it's also somewhere in a smaller print, it's written to you as well, the note as how to get the add-ins. So now we can basically are ready to start. We have standard deviation, expected returns, and the correlation matrix for on the returns between these three securities. So we completed step 1, step 2 of our calculations. Or sorry, haven't done step 2 yet. So step 1 is completed, and we are now to do the step 2, and that is to find what the covariance matrix is. In terms of the covariance, you probably know that it's equal to the correlation coefficient on the returns between the two assets times the individual standard deviation on the returns of these assets. So for the first one, I need to find the covariance coefficient on the US asset returns with the US asset returns. So in other words, when I'm finding the covariance on the returns of one asset with itself, it's actually the variance that I'm trying to calculate. So it's equal to correlation coefficient, which I can find under the previous matrix. So in this case, it's 1 times the standard deviation on the US asset returns times the standard deviation on returns of the US asset again, because we have the same asset returns that we need to calculate covariance for. And it should give me 404. So in the next one, I will have to find the covariance coefficient on the returns between the UK asset and US asset. So that will be equal to correlation coefficient on the returns between UK asset and US asset, which is given in our correlation matrix, and it's 0.53, times you have now a standard deviation on the returns of the US asset times the standard deviation on the UK return asset, and enter. And so you just keep doing that for the rest of them. So for the next one, you need to find the covariance coefficient on the returns between the Australian asset and US asset. So that should be equal the correlation coefficient between the returns on those two assets times the standard deviation, times the US and times the Australian. So that completes the first column of this matrix here. To make it easier for yourself, instead of doing each one of them individually, you can really complete only the first row and use something that we call a dollar signs for those variables that are going to be constant for the whole of the column of that table there. And one thing that you might have noticed that is constant is always the cell D5. In a cell D5, we had a standard deviation on the US asset that is being calculated, because really this is, in the first column, we're calculating the covariance coefficient between the US asset and all the other assets within that are going to be included in our portfolio. So I could have done simply just put the dollar signs around the D5 cell, the reference to the D5 cell. So just a dollar sign in front of D and in front of 5, and I could enter that, and I could basically get my error, so it changes into this little black cross, and it just basically drag the formula all the way down. This is something that obviously I have done, changed one of my cells. Let me just have a look. So it's D13 times the standard deviation in the US times the standard deviation in UK. That one is correct. And the next one is D14, which is the correlation between US and Australian. So that's correct, times the standard deviation on the US asset, which is correct, and times the D7. D13, D6. Oh, they are different. Oh, yes, the 271.60. Oh, yeah. Okay, so that's not a mistake. It's just I looked at 271 and I thought that's different. So the next one is you have to do for the second column, where you're actually calculating covariance coefficient between UK assets with all the other three assets, or the other two assets and itself. So you will go equal, and then you will find the correlation coefficient between UK and US asset times the standard deviation on the UK asset, which is in cell D6, and times the standard deviation on a US asset. Because this is, as you can see, a covariance coefficient that we are calculating between UK asset and with the other two assets and with itself. It means that the standard deviation on the UK asset is going to be a common variable throughout this column, the rest of the remaining three cells. Which means, for the easiness, I could just, again, wrap that cell around with the dollar signs, or reference to that cell with the dollar signs, and then drag the formula all the way down. So that automatically calculates for me the covariance coefficient between the UK assets with itself, and also between the UK assets with the Australian asset. So automatically does it. So you can do the same for the Australian covariance coefficients between Australian assets with the other two assets and also with itself. So that will be correlation coefficient between Australian and US asset, which is in cell F12, times standard deviation on the Australian asset, which is in cell D7, times, what else do we have, times the US, standard deviation on US assets, which is in cell D5, and enter. Because we're calculating covariance coefficients between Australian and the other assets, obviously the standard deviation on the Australian asset will be common throughout remaining those two cells in this column. So what I can do is put the dollar signs around the reference cell D7, which contains the standard deviation for the Australian standard deviation, enter, and then drag formula down. Okay? So this is what you would have to do yourself. Again, do not go to the tools and data analysis and do not use this tool here, because that is not going to calculate the covariance for us the way we want. The reason is because of the standard deviation. We're using a sample standard deviation in our calculations. So use this method that I just showed you. You have to do it basically in a sense manually here. So now that means we have completed a step 2 of our calculations. For the step 3, we said we have to calculate something that we called a border multiply covariance matrix. The reason why we actually are calculating border multiply covariance, because an information from this matrix will be used to find what the portfolio variance is. And to basically find first the benchmark against which we can actually evaluate how efficient the portfolios are that we are finding them, we first construct something that we call equally weighted portfolio, which in a sense means that you will divide 1 by number of the assets that you have in your portfolio. So that will be 1, in our case, divided by 3, because we have 3 assets. And you can see you're going to have the weight on each of the 3 country assets will be 0.3333. Once you have done that, then we will find what the equally weighted portfolio variance is, and also what the equally weighted portfolio expected return is, using the weights that we have entered in a border row and a border column. So in my here template, what I have already constructed a sort of an empty matrix, which I'm going to fill in with the appropriate, obviously, figures. So you can see that here I have left some space, and I labeled it as weights, and I also have here some space left, which are under the labeling of the different types of assets that we have included in our portfolio. In particular, we say we're going to have equally weighted portfolio first, so I'm going to enter sign equal, 1 divided by 3, because that's how many assets we have. Press enter, and then drag the formula along so it fills next to the other 2 assets as well. And then at the bottom, what you will do is type in equal sign, type in sum, enter the bracket, and select those weights that I have just entered. And you will find that it's the sum of those is equal to 1. And that's what it ultimately will always have to be, because you can't invest more than what you actually have. The funds, you can't invest the funds that you don't have. The only funds that you can invest is the ones that you actually have. So that is the border column here. And the border column, all that it does, it just contains the weights on each of those assets that you will include into your portfolio. In a border row here, so that's your border row. Let me label it somehow or color it, okay? This one is very critical for you, because a lot of people, if you make a mistake, I can almost guarantee, I can enter a bet with you that that's where your mistake is going to be. Because lots of people, what they do is they would do exactly what I did for the border column. They would enter the sign equal and then just go 1 divided by 3 and just drag that along. However, in this border row, you can't do that. What you actually have to do is make a reference to appropriate cell in a border column. So if you want to enter the weights for the US asset, you actually have to refer to the border column which contains weights on the US asset. So in our case here, in the border column, the weights for the US assets are in a cell D27, and that's what you actually have to enter in a border row itself. And then you enter, and you will have 0.333, the same information that is given to you in a border column. You will do the same then for the UK asset. You can't enter an equal weight 0.333 there. What you would have to do, you will have to make a reference to a border column cell that contains a weight on a UK asset. And that cell, in our case, will be D28, and press enter. And you do the same for the Australian asset here, or the weight for the weight on Australian assets. So just to make the reference to the D29 cell from the border column. The reason why we're doing this is later when we're actually using the software that is going to help us optimize the portfolio, so find those portfolios that are most efficient, hence the ones that is going to give you a maximum return for any given level of the risk, or vice versa, for any given level of the return to find you a minimum risk. What we need to do is actually we will be changing those weights. So we will change the weights in such a way that it gives you a higher return for a given level of the risk, for example. And when I tell the software to optimize these weights for me, I'm going to direct a software to actually change those cells in a border column. And so if the cells in a border row don't reflect the same information as the one that is in a border column, you will get all the wrong information and you will not be able to optimize your portfolio. So that's what's really important. So do not make that mistake. Hopefully you won't now that I mention it to you. And now what I will do, I will need to fill in all these other cells that are empty at the moment. What I'm actually doing in those cells is ultimately what your standard, the variance formula tells you to do for the portfolio variance formula. So you obviously are very familiar with the general formula itself. And if you were to expand this formula to include these three assets that I just have at the moment in my example, the US, UK, and Australian asset, you will get a number of the different elements to this formula. It will be expanded. And especially if you have a look, for example, the last one, what you're ultimately doing, you're multiplying the weights of individual assets by the covariance that exists on the returns between those two assets. So that's basically where my matrix comes in. But you can see in your formula here, you have this first factor that just multiplies the square on the weights by the variance on the individual assets. That's what the diagonal elements in my covariance matrix basically were telling me. In a sense, this is diagonal elements represent the variance of those individual assets, while the elements of the diagonal ones, on each side of the diagonal ones, what it tells me is the covariance that exists between two different assets. So I'm going to use the covariance matrix and multiply each of these elements by appropriate weights, ultimately to get the portfolio variance different elements in the formulas, and then I will find the sum of all of that matrix to give me one figure which represents a portfolio variance figure. So that's the purpose of doing this border multiply covariance matrix. So the first thing that you now, once you have entered the weights in a border column and border row, you will have to do is click on enter. Then you would have to consult your covariance matrix, and because we are calculating first the first element of your portfolio variance formula, that is actually the weights on a US asset squared times the variance on a US asset. So I will, from the covariance matrix, grab the variance on the US asset, which is 404, and times that by the weight on a US asset that is in a border column times the weights that is in a border row. Okay, so what I have here again is the variance on a US asset times the weight on a US asset times the weight on a US asset. So that represents the first element of your portfolio variance formula for that first individual assets that you are including. Press enter, and that will give you the result for that part of the formula. The next one is you need to find a covariance between the returns on the US and UK asset times that by the weight on a US asset times that by the weight on a UK asset. So what I'm doing here is calculating the second part of this portfolio variance formula. So weight on a US asset times the weight on a UK asset times the covariance between these two assets. So to do that, enter sign equal again, consult the covariance matrix above, and you find where the covariance between these two assets is. So it's, in my case, in the cell D21, times that by the weight on a UK, which is in cell D28, times that by the weight on a US asset, which is in my border row. And then enter. Do that for the next one. So you will have, you need to find covariance between US and Australian assets, which is in the first column, the final cell here in the covariance matrix, times the weight on an Australian asset times the weight on a US asset, and press enter. Similarly to what I have done previously, you might have noticed that a weight on the US asset from the border row, it actually appears in all of these cell references that I just calculated. So the cell E25, so you can see not 25, 26, okay? E26, E26, E26. It's all there. So the one easy way to do it, instead of me doing each one of them individually, would have been just to put the dollar signs around this cell reference and press enter, and then just drag the formula down. And it gives me the same result as what I have just done individually. So it just saves you some time. Unfortunately, if you make a mistake in the first formula, then it just means you drag it all the way. But let's hope you don't do that. And you'll probably be able to pick it up that you're doing something wrong when it comes to the actually solving and finding the optimal portfolios, because you're most likely not going to be able to get the right results. So you'll know along the way that you actually made, hopefully, some mistake. So you have to now do the same for the second column and the third column. So I'll just use the quick way of doing it, the way I just showed you now. So press sign equal. And then for the first one now, you have to calculate find the covariance between the US and UK asset and multiply that by the individual weights. So to find the covariance between these two assets, you will consult the covariance matrix from above, and then multiply it by the weights on a US asset from a border column times the weights on a UK asset from the border row. And then enter. Because the weights from the border row on a UK asset will be common for those three cells, the remaining three cells, then what I can do, and this is in the cell F26, what I can do is just wrap the F26 reference with the dollar signs and drag the formula down. And it just finds me all the remaining elements of the portfolio variance formula. I'll do the same for Australia. So you'll have to enter sign equal. You have to find now the covariance between Australian and US assets, which you can find for the covariance matrix, and then multiply that by the weight on the US asset from your border column, multiply that by weight on Australian asset from the border row, and press sign enter. Because the weights from a border row on Australian asset will be in common to those three cells, again, you can just wrap it with a dollar sign, the G26 reference cell that actually contains the weights on Australian asset, and just drag the formula down. So what that does, once again, it calculates every element of your variance portfolio formula. In order to get that one single number in the end, you will have to find the sum of all of those. So below these cells, what you will have to do in the cell below it, you will have to enter sign equal, enter sum, open the bracket, select the first three elements from a first column, close the bracket and enter. And just drag the formula along so you find the sum of all the remaining three columns as well. But remember, when you're doing the sum, you actually don't include the weights. You only include these 3 elements that we just actually calculated in each of the columns. And then what you have done, you reduced all of these elements to only the 3 figures, but I still have to find that one portfolio variance figure, which is sum of all those 3 sums that I just calculated. So here in my template, what I have done, I left the room for it to find what the portfolio variance is. So just enter the sign equal, enter the sum, open the bracket, and then select these 3 sums that we just calculated. And the sum of all these sums will give you one single number, which is your portfolio variance number. So now you have done portfolio variance. You can find the portfolio standard deviation, as you already know, by finding the square root of the portfolio variance, which means enter the sign equal, make the reference to the cell that contains the portfolio variance figure, and then raise it to the power of 0.5, or whichever other fancy way you want to do it. Okay, so that should find me what the portfolio standard deviation is. What I'll do for a second is I'm going to copy that figure and put it here somewhere on the side. But when I actually copy it, I don't want to just paste it, because that cell actually contains the formula. So if I just paste it, it's not going to give me a right figure. So for example, if I paste it along, look, it just gives me 0, which is not actually what I want it to be copied into that cell next to it. So what I really need to do is use the paste special, and under the paste special, find the values. Click next to the values and click on OK. So now I have, for a reference, this figure of what the portfolio standard deviation is. The reason why I'm doing this is because later when I show you how this portfolio is being optimized, I wanted to be able to show you whether there's a difference in the level of the risk with the first portfolio, the equally weighted portfolio, and the optimized portfolio is. Okay? So I'll come back to that if you don't understand at this point. But the next step, before I can go ahead and construct our efficient frontier, is to actually find what the portfolio expected return is. And with the portfolio expected return, you know that it's sum of all of the products between the weights on individual assets and their own individual returns. So enter the sign equal. And then if you have a look right at the beginning, I have already been given an expected return on these individual assets. So all I have to do is multiply the individual assets by the weights in this portfolio. And the weights are in a border column here. Then that's going to give me an expected return contribution from the US asset in this portfolio, plus the expected return on a UK asset times the weights on a UK asset from the border column, plus the expected return on Australian asset times the weights on an Australian asset from a border column. And just press enter, and it should give me 16.266, which is the expected return on this equally weighted portfolio. So that gives you all of the necessary calculations before you can go ahead and calculate or optimize portfolios or find what efficient frontier is. Before I start optimizing my portfolios, I have already included this template here that is going to gives me a target mean. So this mean here, it's actually my target mean. So what it exactly means is that I, as investor, want to achieve a certain level of the return. So let's say I want to achieve 15% rate of return. The question now is, how should I exactly, what sort of weights on those assets I should include into my portfolio so I can achieve my target return of 15%, but at the minimum possible risk. So what combination of these assets need to be included in portfolio so I can achieve my target mean for the minimum level of the risk? So my target means here I have asked myself I wanted a rate of return of 10%. That's my target. The next one I want my return to be 12%. And so on. So the question now is, you can see I have left a blank next to that, what is the standard deviation, because I want to be able to find a portfolio that is going to give me a 10%, but with a minimum level of the risk. And in my template here, you can see that I also left some space for the weights that is going to be included, or the weights on each of these assets that are going to be included in your portfolio. So it's going to tell me what combination of the US, UK, and Australian asset I can basically have to put in my portfolio to achieve that rate of return with the minimum level of the risk. So that's an idea here that I'm trying to do. And you might notice as well, under the target return here, I have left one cell that is empty. The purpose of this empty cell is actually to try to optimize the equally weighted portfolio. So the question is, can I achieve that same return, the 16.266%, but with the lower level of the risk than the one that we just calculated, which is 18.57% standard deviation? That's really the question that I'm asking myself here. Do I have to basically have the equally weighted portfolio? Do I have to have equal weights on the US, Australian, and UK asset to achieve that rate of return? Or can I possibly actually combine these assets in some different way, in some different proportion, but to give me a lower level of the risk than the one that is showing here? To do that, I will have to introduce you to a tool that we call a solver tool. But before I do that, I have to mention to you that there is two types of efficient frontiers that we can construct, and I think Stephen has already explained you this. There is unrestricted and restricted efficient frontier. Unrestricted efficient frontier basically will allow you to short sell, while the restricted one does not allow you to actually any short selling. What the short selling is, it's basically, in a way, borrowing somebody else's stock. So, and normally it's basically using a lower return stock to purchase a higher rate of return stock. Or the way my slide actually explains it, this is one possible explanation, and that is that you actually borrow a number of the shares from a particular investor through your broker. You sell that shares, and in anticipation that probably the price of those shares will go down, so that you can profit the difference in the share prices. So it's possible, hence, if the share prices go low, so if your expectations come true, you will be able to repurchase the shares at the lower price and basically return them to the original owner. While initially, when you borrow from them, you actually sold them at the higher price. So you sold them when the price was still high, when you borrowed them from them, and then you waited some period of time. When the share prices fell, you repurchased them and you've given them back to the original shareholder. So the difference between the two prices is ultimately allows you to possibly make some sort of profit if your expectations turn out to be right. The other sort of explanation to the short selling, as I said just previously, is that you are borrowing somebody else's shares and using them to basically sell a low return stocks for the basically purchasing, allowing yourself to purchase a high return stock. So that's what the short sale is, and I'm pretty sure Stephen has spoken to you about that, and if he hasn't, he will. He might. And then what I will now do, once I have given you an explanation about the two different types of the efficient frontiers that you might construct, I can actually introduce you to the tool that is available in Excel spreadsheet, and it's a called Solver software tool, which allows you to basically optimize those different portfolios and hence help you to construct an efficient frontier. You don't have to obviously use an Excel spreadsheet. If you become really a finance guru and later on you work in the finance industry, you're probably going to use some other software that is much more sophisticated than Excel spreadsheet. But nevertheless, Excel spreadsheet can do the job really nicely. And for our purposes here, it's quite useful because it gives you exposure to exactly what the portfolio optimization is about. To find the solver, if you don't have the solver already installed in your computer, and most likely, if you have never used it, it won't be there. So what you will have to go, you will have to go to the Tools menu. You will have to go to the Add-ins, and under the Add-ins, you will have to find the Solver add-in selected, and hence it should be available there. So if I go to on the Tools menu, go to the Add-ins, and you can see this one add-in that's available. The last one is the Solver add-in. I already have a tick next to it, which means it already has been installed. But if it hasn't been, as I say, just tick next to it and click on OK, and it should be there. So next time when you go to the Tools menu, you should be able to find it as one of the options given there to you to choose from. So now I'll click on a solver, and what I get this window that asks me to enter the solver parameters. The first thing that is asking me is to set my target cell. And remember what my question and what my objective here, which I mentioned was, is for each of those target rates that I'm trying to achieve from my portfolio, I want to actually minimize the level of the risk associated with each one of them. So really, for your set target cell, what you need to do, you want to minimize the level of the risk. Whether you choose the variance as your measure of the risk or a standard deviation is up to you. They ultimately tell you the same story. However, I do prefer to use the standard deviation. So I'll just click on the cell standard deviation here, so which is D32, and that is what I want to minimize. So below the set target cell, you have been asked to specify what that cell needs to be equal to. Do you want to maximize it, do you want to minimize it, or do you want it to be equal to a certain value? I certainly don't want to maximize it. Really what I want to do is to minimize it. Now you would have to tell Solver how you're planning to achieve that. How are you actually going to minimize the level of the risk? And I'm going to tell it that I want to achieve that by actually changing the weights on these individual assets which are contained in my border column. So I will select all of the cells from a border column under this here under this option by changing the cells. The next thing that I need to be telling the solver is, what are my constraints, if there is any? And there is a number of the constraints. In particular, if you look at your slides, it will ask you, we say that for the unrestricted efficient frontier that does allow short sales, there is two constraints. The first one is that sum of all of the weights will have to be equal to 1. So remember what I mentioned previously, you can't invest a money that you don't have. So it's only the money that you have that you're investing it in this case. How you get that money, whether you're borrowing it from somebody, that's another story. And then under the second constraint, we say that your portfolio expected return will need to be equal to your target. So I'm saying that this portfolio expected return needs to be equal to what I desire my expected return to be. So I'll go back, and under the subject to the constraints, you can see there's a number of the buttons here. Click on Add, and first we can basically say that a cell that contains the sum of the weights, which in my case is cell D30, I want that to be equal to 1. Then you will click Add, and you would have these cells will be emptied. Don't worry, in the background, your information that you just entered, your constraint that you just entered has been saved. When you click on Add, it basically is asking you to add the next constraint. And the next constraint, which I said was that my portfolio expected return that we just calculated needs to be equal to my target return. And my target returns are actually given in this table below, that is actually still mostly empty, except the fact that it contains the number of the different targets there. So I'm going to, first portfolio that I'm going to optimize is this equally weighted portfolio. So I'm going to tell the solver to keep that portfolio expected return equal to the target of 16.26%, but by, again, trying to change the weight in such a way that hopefully is going to minimize my standard deviation. So I'm going to click on OK, because I have entered all my constraints now. And really, I'm now ready to optimize that portfolio. So all I have to do now is on your far right button here, I have to actually click on a solve. So I'm going to click on a solve, and what it comes up is a solver result. You can already see in the background the figures have changed, but the Excel or the solver is actually asking me, do you want to keep these numbers or do you want to restore to original values? I do want to keep them because I want to be able to use them and enter them in this blank table below. So you can see now what has taken place is that weights have changed. They're not equally weighted anymore. And next thing that is worth noticing is that your portfolio standard deviation is no longer the same. There is a small difference in your level of the risk now. So in other words, you'll still be able to achieve the same level of the return, which is 16.26%, by arranging these assets in a different way, including them in a different proportion, and at least, even though slightly, but still minimizing the level of the risk of that particular portfolio. So now what you would have to do is you will really, before I enter that, I just want to show you on your handout. This is really what's taking the place. Is on your handout you can see that for the same level of the return, which is 16.27%, previously you had a high risk associated with that, which is captured by this point A on the graph here. And when we optimize it, the portfolio, we have the first point on this efficient frontier which we are trying to construct. And because on the efficient frontier, all of the portfolios are optimal, meaning for that same level of the given risk, you're actually able to minimize the risk, and you are operating on that point B on the efficient frontier. That's really what has happened in our calculations here. But before you can go ahead and find all the other points on the efficient frontier, you will first need to copy and paste these cells in this blank table below. So the first one which I'll do is I'll copy this portfolio standard deviation, and I'm going to paste special it in the cell next to the particular target return. What I'll also do is I'll copy and again paste special all the weights that need to be included on a US, UK, and Australian asset in order to achieve that combination of the return and risk. And then you will do that for the number of any other target returns that you have. So I'll show you perhaps with a couple more before we move on. So for example, if I want to optimize my portfolio so I achieve the level of the return of 12%. So that's the level of return that I want to achieve. But I want to be able to achieve it at the minimum possible level of the risk, and I'm asking the solver, how can I achieve that by arranging the weights in these assets in such a way that will allow me to do so. So I'll go back to the Tools menu. I'll go back to the solver. And under the solver, I still want to minimize the portfolio standard deviation. I still want to minimize the risk. So I do not make any changes here. I still want to do that by changing the weights on the individual assets. So I'm not going to make any changes there. But the other change that I want to do is the change to one of the constraints. So what I'll do is I'll click next on the button change here. Oops. Okay. You have to select the constraint. I do not want to change the first constraint because I want still the sum of my individual weights to be equal to 1. However, the next constraint is the one which I'm interested in changing. So select it and click on change. and will ask you that your portfolio expected return now, that is in cell D33, I want it to be equal not to the run of the 16.26%, but as I said, I want to be able to achieve the target return of 12%. So I select the reference cell that contains the return of 12%. I click on OK, and then I click on Solve. I've been asked again whether I want to keep the solution, and yes, I do want to keep it. So now what I have, it tells me that portfolio return is changed. It's 11.999. You can round that up to 12%, and it's done it in a way that it gives me a portfolio standard deviation of 25%, and it's done it by this sort of combination of the individual asset. So what I'll have to do is I will have to copy and again paste special in a table below this information. Okay, so that's what I'm doing. The next one perhaps I want to do now is I want to achieve the target return of 14%. So I'll go back to my Tools menu, go back to the Solver. Again, I'm not going to change my target cell. I'm not going to changing the cells here. All I want to do is going to change this constraint. So I want my portfolio mean to be actually equal to the target of 14%. So I make a reference to that particular cell, click on OK, and then click on Solve. And then click on Keeping the Solver solution. So what you'll get here is you're going to see that the portfolio mean is equal to 14, but it's done in such a way that your portfolio standard deviation has been minimized. You copy and paste special that, and then you also copy and paste special the weights. I'm not going to do that now. And you have to keep repeating the process. You okay with this? I don't have to repeat it one more time? No? Okay? So this is the next part of your exercise here is to actually show it on a chart. So what you have to do is go to your chart icon here on the tool menu, and then you will have to go to the XY scatter chart, and in particular you will have to go to the line scatter type of chart, and then you're being asked to select the data. I'm not going to use a data range because if you have ever used Excel previously, you might know that whatever is in your first column is actually going to be plotted on your x-axis, and whatever is on your second column is going to be plotted on the y-axis. And if you notice, what I have in the first column is actually mean, the expected return, and in the second is the standard deviation, which means that my expected return will be plotted on the x-axis, and I don't want that. As you obviously must know by now, expected return needs to be on the y-axis. So I'm not going to use this data range option, but I will go to the series option that I have here at the top. I'm going to click on Add, and then I'm going to say that I want to, my curve that I'm constructing here is efficient frontier. And I'm going to say that my x values here are the standard deviation. So I select all of the data that we just calculated for all of the optimized portfolio on the standard deviation itself. And then for the y values, I'm going to enter all of these values, or select all of these values that we just calculated for the portfolio expected return. And so you can already see here at the top, I got something that is resembling the efficient frontier. I go click on the next, and you can enter here the values for the x-axis, so you can enter the standard deviation, and for the value for the y-axis, that was the expected return. So you can label the graph, click on next, and it's asking me where I want it to be displayed. I'm just going to keep it for the moment in this spreadsheet here. And so this is how it looks like. So you can obviously make it prettier, so it's actually a little bit nicer presented than what mine is. But you can do the formatting yourself if you're knowledgeable about it. But this is the one that I previously prepared, and this is how it looks like, a little bit more formatted. So that's your unrestricted efficient frontier. I'll quickly show you how to do the restricted efficient frontier. Oops. So what I have here is all the information that we already have calculated. That's information on the standard deviation, on expected return on the individual assets, correlation metric is there, covariance metric is there. I do have the weights that are already there as well. I'm just going to quickly get rid of this. And this is basically back to the equally weighted portfolio that we just calculated a few minutes ago. Now, if I want to construct the restricted efficient frontier, we have a third constraint that we need to include. And the third constraint is the one that doesn't allow you for the short selling, which means that the weight on the individual asset cannot be negative, indicating that you actually borrowed those shares or those assets from some other investor and then use the proceeds of the sale to actually invest it somewhere else. So in other words, we're just selling now the solver, that all of the weights need to be positive weights, meaning that no borrowing, no short selling is allowed in this case. So while previously, if you have a look with the unrestricted efficient frontier, when we calculated it, there was a number. Well, I just want to move it. Doesn't want to let me move it. Here. You can see this number of the weights that are actually negative. What does that mean? It actually means that you have short sold this US asset. You have short sold UK asset and you use the proceeds of the sale in those assets to actually invest it into the obviously higher earning, higher return asset, which is Australian asset in this case. Okay? So that's what you basically have done, what we have done previously. But in this situation, as I say, we don't want to do that. We only want to invest our money within those assets. One interesting thing that I need to draw your attention now is when you're constructing the restricted efficient frontier. In that case, you're really bound by the minimum and the maximum rate of return that you can earn on the individual asset, which means when you are constructing an efficient frontier and trying to optimize your portfolios, the target return cannot be beyond this mean and maximum on the returns on the individual assets. Okay? So given that our minimum expected return on the individual asset in this case is 14.8, we can't basically get a target mean that is below 14.8. You can get a 14.8, but that in that case it means that you're investing all of your funds into the Australian asset. If you look at the maximum expected rate of return on the individual asset, that is 18.3%, which means you can't achieve a target return that is higher than 18.3%. So you probably, as you can notice, you can construct something that's between 15 and 18% the target mean. So that's the first distinct difference between the unrestricted and restricted that you have to pick up. And again, in the past, I have seen lots of people, when they do make a mistake in constructing the restricted frontier, is that's exactly where they make it. They go beyond the minimum and maximum on the individual returns. So what I need to do now, I have my equally weighted expected return, portfolio expected return. I'll go to the tools and I'll go to the solver, and you can see that I already have specified to the solver that I want my portfolio variance this time around to be actually minimized. And I want this to be done by changing the weights on the individual assets that are in a border column. And the constraints that I have specified, you can see, is that I want the weight on the US asset to be equal or greater than 0, so it has to be positive. The weight on the UK asset has to be positive. The weight on Australian asset has to be positive. And I still have the other two constraints, which are that the sum of all of the weights need to be equal to 1, and also that my portfolio expected return needs to be equal to the target return. So I'll just change that one for a second, and I'm going to say that I want portfolio expected return to be equal to this target of that is contained in a cell D40. So I want to optimize my equally weighted portfolio. So once again, I want to be able to see whether I can achieve for the same level of the return a lower risk than the one that we currently have on the slide here, which is 18.57. So I'm just going to say on OK and click on a solve. Yes, I do want to keep a solution, and you can see that our portfolio standard deviation has gone down slightly. So it's a little bit lower. So how have we done this? Is by changing the weight in such a way so they're no longer equally weighted. You have a little bit more weight that is a proportion of your funds that is invested into US asset, and slightly less than equally weighted in Australian assets. So great, more in a US asset, a little bit more, less in a UK asset, and the lowest proportion is in Australian assets. So that's how you're changing them in order to achieve the same level of the return, but at the lower level of the risk. So again, you will copy and paste special that information in a table below. And then what you will do is you will try to solve some for the others as well, for the other values that you have. I'll just quickly do it for one more, and then we will move on for the following calculations that you require for your assignment. So the next one is, again, select that constraint, click on a change, and let's say this time around I don't want my portfolio return to be equal to the 16.26%. I want it to be equal to 15%, let's say. That's the target return that I want to achieve. Click on OK, click on Solve, keep your solver solution, and you will see now that for the 15%, you can do so by investing nothing at all in a UK asset, investing a lot more in Australian asset, and slightly and a little bit in a US asset. And you'll do so at the level of the risk of 17.9%. So copy and paste special that information in the template below. Once you have done that, then you will be able to, again, construct the chart from there. And the next set of the calculations that you will need to do, once you have constructed your efficient frontier, the question is where on this efficient frontier is basically the best portfolio, the one that is going to give you a highest possible reward to variability ratio. So to find that, you will calculate, you will use the formula for the Sharpe Ratio. And the Sharpe Ratio, you probably know that what it does, it will tell you the maximum slope of your capital market line that is basically going to be tangent to the efficient frontier. So to find the Sharpe Ratio, you will find the difference between expected return on each of those portfolios that we have calculated that lie on the efficient frontier as well, and minus from those portfolio expected return the risk-free rate of return, and divide that by the standard deviation of the optimized portfolio. So now what I have done here on this next spreadsheet, I got the information on the unrestricted efficient frontier that we have just calculated initially, not the restricted, unrestricted one. So all I have done really here is copied and pasted information about the portfolio expected return and the portfolio standard deviation. Next to it, you can notice that I have also inserted the information on the risk-free rate of return, which is given to me at 11%. So in your assignment, you're also being given what the risk-free rate of return. I can't remember now what exactly is, but if you read the text carefully, that information will be given to you. So now, all you have to do is, given that you already know all of these variables, you will need to use them to find the Sharpe Ratio for each of those optimized portfolios. So you would enter sign equal, enter the brackets, and then say the standard deviation on the first optimized portfolio, not the standard deviation, the expected return on the first optimized portfolio minus the risk-free rate of 11%, close the brackets and divide that by the standard deviation on this first optimized portfolio. And press enter. Then I'll just show you for the next one. So for the next optimized portfolio, which I named it here as portfolio B, I just given them the names ultimately. So for the portfolio B, enter the sign equal, enter the brackets, and find the difference between that portfolio's expected return and the risk-free rate of return of 11%. Close the brackets, divide that by the standard deviation on this optimized portfolio, and then enter. To make it easier for yourself, once you have done it for the first, once you calculate the first Sharpe ratio, all you can do now is actually drag the formula all the way down, and it does it for you. That's the subsequent calculation, so you don't have to do it individually. The next thing that we need to do here is we need to find the one with the highest, basically, Sharpe ratio. Because the one with the highest Sharpe ratio will tell you where is the highest return that you can earn for the given level of the risk. So in this case, if I actually scroll or eyeball this information on the Sharpe ratio, I'll probably see this one is low, going up, going up, going up, still going up, and then going down. So which means that the highest one was there at 0.305. So that's my highest Sharpe ratio, which means that this portfolio G is my optimal portfolio. It's your the portfolio that is going to allow you to earn the highest reward to variability ratio. In this case, all I have to now do is copy the information below in terms of the return that you're going to earn in that portfolio, which is 18%. I already have this little table here, and all it does have, again, it's a mean and standard deviation, and I already have entered the information for the risk-free rate of return. Why do I need this information? Because I'm constructing a capital market line. And if you remember the capital market line, it really goes from the, you don't call it capital market line anymore.
Capital allocation.
Yeah, capital allocation, because the last book that we use is actually called a capital market line. So it's a capital allocation line, and what it does is you already know that it starts from the risk-free rate of return, which is on your y-axis. Then it basically is a tangent to the efficient frontier at some point, and that point of the tangency is the one that I just basically calculated here. And then all you now have to find is the third point where it's actually, you can get a line, a capital asset allocation line, which is actually go all the way from the risk-free point on your y-axis through the point to the tangency and basically further to the right. So I already have that point for the risk-free assets. So it's 11% is the rate of return, standard deviation is equal to 0. And so this following information that I need to enter is for this optimal portfolio which has expected return of 18%. I copy and paste the information about its standard deviation. And now all I have to do is I'll show you. If I use this information, where's my chart? This is my chart here. And if I right-click on my chart, and if I say source data, I go to the series here, and I want to add another series. I want to call it capital allocation line. And for that information about X values and Y values, I'll go to that information that we just calculated, which is I'm going to enter an X value, which is standard deviation here. So I select that information. And then, oops, just those two variables. And then I will find what is my Y values. So I go back to that sheet, which is here. And my Y values are expected returns. So you can see now what I got. Hopefully you can see it. Yeah, you can see it? Yeah. So what I have is a capital allocation line that goes from the point on the y-axis to the tangency point, but if you want to get it that it goes all the way to the right, you will need to give it a new set of information. For example, what I normally do, so I've seen people use different techniques, but I'll show you what I use. I will randomly pick a standard deviation, value for a standard deviation that is higher than the one that we just calculated for the optimal portfolio that's tangent to the efficient frontier. And I will pick something, let's say like 50 here, because should give me the furthest point to the right. So I'll go back to my calculations here, and I'll say randomly selected number. You could have done a 40 or 45 or 50, whatever you want. So as long as it's higher than this standard deviation of 22.92, and a little bit more significantly higher, so it gets you that point furthest to the right. Once you have done this, now what you have to find is what is the expected return that is actually associated with that level of the standard deviation of 50 that I just picked. What I normally do is enter sign equal, enter the brackets, find the difference between the two standard deviations, the ones that I just randomly selected and the one from the optimized portfolio, times that, the slope, the Sharpe ratio, and plus the expected return of this tangency portfolio. So it gives me that third point. So it tells me now that for the standard deviation of 50, your expected return is 26.27. So I can go back to my chart and I can add that piece of information. So I can go back to my source of data, and if I click here on a capital asset allocation series, I can basically just adjust my X values now so it includes that extra information that I provided. And then I can do as well for the Y values, select all the three, and if I go back to my chart, you can see it's got me a nice capital allocation line. Okay? So that was the purpose of that. Once you have found capital asset allocation line, what you now want to do, I believe your assignment asks you to find for a certain type of investor where exactly he would be investing, okay? Because it's just what we have done so far, give us a broad understanding of what are the optimized portfolios and what are the basically most efficient portfolios. However, we want to find out, given your level of the risk averseness, where exactly on this capital allocation line would you be investing. And I have been, to find that, we're basically going to find first an optimal proportion of the risky portfolio that a certain investor should be investing. And this is the formula that I will be using. So Y is just an optimal proportion of the risky portfolio, and it is calculated by finding the difference between expected return of the portfolio minus the risk-free rate of return and divided by 0.01 times A, where A is actually gives you a degree of the risk averseness, which again is given to you in your assignment. You're being told exactly what A is, and times the variance of the portfolio. I'll draw your attention to this 0.01. 0.01 is there if you're actually using the data, if the data is expressed in percentages. If you have converted, and I've seen these people do it, I'm not quite sure, there's no need to convert the data that is given to you in your assignment, but if by any chance you do it, then there is no need to actually include 0.01 in this formula, because 0.01, what it does, it's basically a scaling factor. That's all that it does in this formula. So I'll use that formula, so the proportion, optimal proportion in the risky portfolio that you should be investing for a certain risk-averse investor, to find exactly for this set of information how much my investor with the coefficient of risk aversion of A equal to 4 should be investing in this optimal portfolio. So in this case, I would say enter the sign equal, enter the brackets, and then we said you expect a portfolio expected return of 18% minus the risk-free rate of return of 11%, which was given to us, divided by, open the brackets, 0.01, the scaling factor, times the coefficient on the risk aversion, which was given to us as 4, and times the standard deviation on the portfolio. But in this case, we need to square, because really what we need is the variance of that portfolio rather than just a standard deviation. Close the brackets and enter. And so what it tells me is that this investor should be, basically with this level of the risk aversion, should be investing 33.3% into this optimized portfolio. Your assignment also asks you not just that, but it asks you to tell this investor exactly what does that mean in terms of the individual weights on the individual assets, how much they should be investing, i.e. how much they should be putting into the US asset, how much they should be putting in UK asset, how much they should be putting in Australian asset. We know all combined, for all three assets, they should be investing 33.3% of all of their funds into this risky asset. And reminder of it, so which is, 66.6% should be invested in a risk-free asset. We know that, but we need to now find out how much they should be investing in each of those assets. So for that, what I'll do is enter the sign equal, and you will basically multiply the weight on the individual assets by this overall weight that you will be investing into this risky asset. So it tells you that you should be putting 19.09% of all your wealth into the US asset or US stocks. To find for the UK asset, you multiply the weight on the UK asset by this optimal proportion that is invested in the risky assets of 0.33, enter, and it tells you that 25.5% of all your wealth should be invested into that UK asset. And then for the Australian, you just multiply the weight on Australian asset by the optimal proportion that is invested into the risky portfolio, and it tells you that in this case you will be doing that by short selling by 11.3% into the Australian stock. Okay? So now what we have done, we constructed a efficient frontier, we constructed a capital allocation line, we find the optimal portfolio on the capital allocation line that is tangent to the efficient frontier, and then we find out that an investor with the risk aversion of 4, how much exactly they should be investing into the risky portfolio. And finally, we need to just find out exactly for this investor with the risk aversion of 4, how much they can expect in terms of the return that they earn on this portfolio, and what is the risk that they're being subjected to. So to find the standard deviation, I'll do that one first. All that it is to it is the standard deviation of the risky portfolio times the weight on the risky portfolio. So we have that standard deviation is 22.92 times the weight of 0.33, and it tells me that the standard deviation for this investor is 7.6%. So for the expected return, what it is, it's equal to the expected return on a risky portfolio of 18% times the weight on a risky portfolio of 0.33 that we just calculated, and then plus the remainder of the funds are being invested into the risk-free asset. So 1 minus the proportion invested in the risky, 1 minus the proportion invested in a risky asset, which is 0.33, it's invested into the risk-free asset, times how much you're going to be earning on the risk-free asset, which is given to us as 11%. That's the risk-free rate of return. So now you have expected rate of return formula, and just enter it, and it tells you that this investor will be earning 13.3% on this portfolio that is investing 33.3% into risky portfolio and remaining risk-free asset, and is subjected to the level of the risk of 7.6%. And the last thing that you might want to do is actually put that sort of information on your chart as well, like what I have done here. So I have a capital asset allocation line, you have efficient frontier, and all you have to do to add this point, so this triangle actually tells me that this investor with the risk averseness of 4 that is actually investing into this portfolio on capital allocation line, which I can get by right-clicking on my chart. So I'll actually go back to my original chart, if I can find it now. Just bear with me. So this is my original one. So I right-click on it, go under the source data, and then add the next series. And next series, I'll just name it as A equal to 4. I have to enter the X value, which is the standard deviation. So I'll go back to my calculations, and I'm going to say that needs to be equal to 7.6. Then I will basically enter the Y value, which is 13.33% that I just calculated. And I just click on OK. And it's missing there probably because it's, see, I found it. It's obviously, it's colored yellowish at the moment, so you can't see it. But if you know approximately where it is, if you right-click on it, you might be able to find it. So I'm just going to format that data series, and I'm going to give it a really strong color of some sort. I think that's a marker. Yep. Let's say that's where I want something really big. That's it. That's where that point comes from. Okay? So all you have to do is, again, right-click, go to the source data, and add the series, and enter the correct X and Y values. And that's basically enough for you to complete your assignment. And so good luck with your assignment.
Thank you. Well, I hope you appreciate that. Nobody's ever going to explain solver like that to you again. And if you don't understand it now, you never will. But, of course, hopefully, Senada remembers not to log out of the computer before I upload the video. You can watch it again. Your tutors won't answer questions on it, neither will Senada. You also have it explained in the textbook. I used to do presentations a bit like Senada did, except not as good as that, in London, and people used to pay, I was just working out while I was sitting there towards the end, they used to pay about, and this is some years ago, about $500 each to come and sit through what we've just done. And I was also thinking about how many of you were here, and I worked out actually if we'd managed to do that for Senada, and she got to keep all the money, she would have made $100,000 this evening. She's actually going to get paid after tax a bit more than $100 for doing that class with you. So another round of applause would be nice. Thank you. So you can go home now.